Hello and welcome to my morning note. Everybody is talking about currency wars once again, and that's understandable because Japan is quite openly fighting them, trying to push down the value of the yen. Now, the most conspicuous loser of that currency war so far would have to be the euro. The eurozone really could do with quite a weak currency at the moment, you would think, but the euro is appreciating quite rapidly. Less remarked is that one very big currency army is remaining on the sidelines, and that's China with its big pile of reserves. What are we to make of all of this? With me now to discuss it is Bank of New York Mellon's chief currency strategist, Simon Derrick. Simon, thanks very much for coming today. Let's start out by taking a look at why Japan might want to be doing this, and one of the more conspicuous losers, which is Korea. This is what's happened to the yen against the Korean won since 2007. Why are Japan doing this?
Well, I think it comes down to simply the fact that they need to give additional competitiveness to their exporters. If you look at the performance of the Nikkei against the yen over the course of the last few years, every time you've seen the yen strengthen, you've seen the Nikkei weaken. They need to get additional competitiveness, and particularly against their direct competitors within the region. So here we're seeing very clearly, as the yen is weakening on the back of easier monetary policy, we're starting to see the Korean won come under increased upward pressure. And of course, that's going to have a very direct impact on the likes of Samsung. And of course, we're now going to see the central bank obviously trying to stop that happening. But is there anything very much that the Koreans can do about it? I mean, they still obviously have a much weaker currency than they did in the era of the Japanese yen currency trade. I think they can slow the pace of appreciation for the won, and I think that is exactly what they're doing. But in terms of can they really take on Japan at G20, even with the help of the Europeans? Probably not, simply because they don't have the support yet of the United States, which has been noticeably very quiet on this. And it's also going to be said that China hasn't said a great deal either. Now, that's interesting. We'll go on to this fascinating chart that you've compared. China and the US are the two countries that really cannot be ignored in any currency war because they really do have the power to manipulate their own currencies. Take us through this chart, which compares the two things you wouldn't think had much to do with each other, the euro-dollar exchange rate and the level of Chinese reserve accumulation. Absolutely. To me, it's been one of the most fascinating charts over the course of the last decade. Each bar represents the quarterly reserve growth in China's reserves. As you said, the line is the performance of the euro against the dollar. The key point is that China, like other reserve managers, does not keep all its eggs in one basket. It probably takes somewhere between 25 and 30% and sticks it into the euro. So when its reserves are growing, i.e. when it's got a good surplus, absolutely, and when there's a lot of money pouring in and they're intervening aggressively in the market to keep the yuan constrained, they have a large chunk of reserves come in, and therefore they have a large chunk to take out of that and put into the euro. So when you see big reserve growth, you see a strong performance for the euro, and vice versa. Which explains a few of the anomalies we've seen during the Eurozone crisis, the great weakening in the euro when the Greece first blew up, and then the way the euro stayed strong during 2011 when things really got very much scarier. Absolutely. This time last year, in the middle of a first bailout for Greece, the euro strengthened. China's reserves were growing during that period. That's why, more than anything else, you can explain this great anomaly as to what's going on. Now, for the future, however, China has an inflation problem. It appears to be benignly allowing its currency to strengthen. And as your chart shows, its reserve growth obviously has declined very dramatically, and yet the euro has, as we all know, been doing very well the last few months. Is this ultimately a bearish sign for the euro? There's no question that if you listen to what Chinese officials, particularly from the PBOC and SAFE, have been saying, they're telling us they're pulling away from the market, that they've got enough reserves, they don't want any more to go. So in the long term, they're not going to be there as a buyer. And that therefore suggests to me that once the immediate currency war story, the South Koreans, the Taiwanese, and the other people that are defending the currency, once they pull away from the market, then actually the natural support the euro's enjoyed over the course of the last few years starts to decline. So actually in the long run, this is absolutely a bearish euro story, which is good news for the likes of Michel Hollande and the likes of Angela Merkel, who are clearly calling for a weaker euro right now. Okay, Simon, thank you very much indeed. Just to wrap up, it's also, I suspect, rather good news for Mario Draghi. The ECB, which meets later this week, might just be becoming under pressure to try to fight currency wars itself if current trends continue. It's just possible that the longer term trajectory of Chinese reserves means that they won't need to.